Right, welcome to this 4-hour market rhythm video. It's all about a system that I've been involved with for the last, I think, six or 7 years. And it's been published on forexfactory.com. You can go and have a look there. I'll put the link on later on. It's it's totally free for everybody that wants to go there. It's based upon a unique sort of way that I came across that the market move when the market is in a certain direction, either up, down, or even sideways. It's based upon the fact that I don't look at the graph anymore in terms of price. I don't look on the right-hand side and say it's 1.4, it's expensive, or it's cheap. Even there, one can debate a lot, because right over there, let's say right over there, is that price expensive or is it not? The reason is people are still buying it at that price, so that makes it cheap. Right down here, is that cheap or not? Why aren't people buying it upwards? Right, and now I'm talking more in stocks at this stage, because here you can go long and short. But is that value right over there? People still think it can come down. The same over there. So there's not really something like that I'm looking in. When I look at a graph, I see the actions of people. Yeah, I know they say that news are moving the market. In a sense, that's true. But if you take the people factor out, you take people out, news can do nothing to the market. And what amazes me sometimes is that good news doesn't take the market in the direction that good news is supposed to take it. Sometimes the good news comes already right up there when the market has already anticipated the inside people, the inside information. So for me, it means that to be able to be in that move, I have to be in there because of a certain way people react. And just look that tail, for instance. Right, that one over there already tells me a story. We're going to look into that later on. So that tells me there's a certain rhythm busy taking place, and because of that, I can have quite a good anticipation and put the odds in my favor that the market is going possibly to do a certain thing. I can never say it is going to do that, but I can adjust myself and get myself ready and build a plan around that specific rhythm that I see. Now that's very important, because it's all about a plan. I always say to people, the facts are in front of me, therefore I will do this and I will do that. I cannot build any strategy or any system upon hope. I'm entering there and hoping it's going up. Hope is not a strategy or a system. So you've got to have a plan. And that's what I'm going to show you in this video. I'm not going to show you a system or a specific strategy to tell you this is where you must put your stops and things like that. I'm going to show you the market rhythm. And once you can identify the market rhythm, you can basically use any strategy, what you can find on the internet, and you can see the weak and the strong points of that strategy in a certain market condition according to the market rhythm. And according to that, you can then say, right, this strategy I can use. Let's say you've got a strategy that are doing very well in an uptrend. Then you know that little piece there, you've got to use that. But as you can see there, it's flattening out, so it starts getting more in a choppy market. Then you know you've got another strategy for that type of market. We're going to look into that just a little bit later. But that's basically it. First of all, I've got some moving averages. The yellow is the 200 moving averages. It's a normal, simple moving average. That light blue is 89 simple moving average. The green is a 21 exponential moving average. And that dotted one right over there is an 8 exponential moving average. And then right here is a very slow 365 exponential moving average. I'm going to explain that later on as we go on. What is the purpose of these moving averages? I'm not trading crossovers or things like that. A moving average for me is like that 200 moving average is the last 200 candles, in this case 4-hour candles, moving average. But it's more to me than just the moving average or the price, the average price of the last 200 candles. To me, that is the direction of the last 200 news, 200 4-hour candle news. If this was days, it would have been 200 days worth of news. People has acted upon that news. That's why the average are there. Because price is based upon the news people have, and they acted upon it. So for the last 200 candles, that is the direction people are taking this into because of the information they have. That one, the blue one, the 89, is the last 89 candles. The news of the last 89. So now we're getting to a little bit of a shorter term. Then there's the 21. Right there you can see it. That's a 21 exponential moving average. Why am I using a 21 exponential? You will see later on. Right, I'm not going to explain it at this stage. We will do that later on. That's the 21 exponential moving average. That is the 8 exponential moving average, all based upon news and information people have. Exponential, all the difference there is it gives more weight to the last couple of days. Now that formula, I'm not 100% sure about it, but all I know is it's not taking the average of 21 days. It's got the last 21 days, but it gives more weight to the last couple of days. That means the fresh news has got a bigger impact on the move than, let's say, the first day. Day number 17 is going to have a much bigger impact, that news, than day 1. Because day 1 has already been, let's say that was day 1. Day 1 has already been counted for. But if 17 is severe, one have to, then that's going to carry more weight. As you can see right over there, it turns quite quickly around right over there. So something happened over there. And that's why I call the 21 EMA as my decision-making moving average. The yellow, the 200, is more or less my fundamental one. As long as this is in an up move, everybody, as far as I'm concerned, are happy. That's the direction we want to go. The blue one, the 89 moving average, is my what I call mood indicator. That tells me when the price is below it, the mood is bearish. And when the price is above it, the mood is bullish. But that doesn't mean that the yellow is in the same direction. Because fundamentally, we can be in a strong up move with a retracement, and it might be seen on the 89, but that does not mean that we are in bearish mode. You see right over there, you can see the 89 is coming down, but the 200 is still moving upwards. So fundamentally, we're still okay. Right over there, it came below the 89. So this piece is, we are in bearish mode or mood. Let's rather call it mood. But fundamentally, we're still in an uptrend. You can see right over there, still up, still up. Now you can start see right over here, it starts getting flat. So now you must know right over there, you can see fundamentally there's something happening. And that's when one must know that something might happen. It took quite a while for it to sort itself out. But don't worry, you're still going to get involved right over there because of the decision making moving average and the mood indicator, the mood moving average. The mood is bullish because we are above the 89. All that the yellow tells you, it started going flat from an up movement, so there might be something coming. And then eventually, right over here, where we are now, you can see it's still about flat. There's a hint of turning around. So you can see the last couple of weeks, there was quite a lot of volatility market moving up and down. That's basically the broad picture that I want to bring you. Here is the MACD that I'm using. It's a 513.1 setting. Somebody wrote us the MACD custom indicator that just color the different bars, the down bars red and the up bars green. We're going to get into some of the patterns that we're using, or entry signals as I call it. But first of all, I want to share with you the market rhythm. When the market is running in a certain direction, that there is definitely some rhythm, that when you see that, you can exploit that and get into the market at a place where it puts the odds in your favor. That is very important, because a lot of people get involved in the market. Let's say this is a down run, and they get right over there and they see the market is going down. I've got to enter. Now they enter there. And look what happened. 118, 120 pips move backwards. And they only had their stop about 90 pips just above there, and they get taken out. So that was not a good place to get into the market. There was the good place to get into the market. And I'm going to show you why that was a good one. I can just as well show you. There's one type of setup we're talking about a lot. You can learn that in the Forex Factory. We call that a TC. That's a trend continuation pattern. Right over there. After that red candle, this red one, you can enter right over there. Stop loss is about 60 odd pips. Although it was a Friday, so be careful on Fridays as well, but at least you could have get that out there for 70, 80 odd pips. That's just one type of signal that we are using. You can see right over there, there's also a TC on that green right over there. That makes it a good setup. But let's look at what I call a rhythm. And I'm going to show you the overall market rhythm, and so that you can understand the way that the market is moving. Right. What happens is, you'll find the 21 EMA doing something like that, and then you will find the price is doing that. Well, I wish it was always that nice, but it doesn't happen always. But what I'm talking about is those pullbacks towards the 21 EMA. But what is important is, you will find that the 89 sometimes is doing that. So the price is coming from below, above the 89, then pull back to the 21, and as long as it do that, the good places to enter the market, as you already have seen there, is right at that spot over there. That's very important. Now, a lot of people see the market run and they get involved there. And then it drops and they get out there. They get involved there and they get out there. And then they say it doesn't work. It's even in stocks, it's a lot like this in stocks. So that is why people are, they got the direction right, but they got their timing wrong. And that's what I want to show you in the market rhythm. When there's a crossover of price and moving averages, you will sometimes find that the price just got that one little tail down to the 89. That's the one we just saw earlier on. That one right over there. Right over there. You're going to get that. So, but when you see that and it goes back up, you know what is it saying? It is telling you something. The facts are in front of me, therefore I will do this and I will do that. So now you know you can go long. You don't even have to have your stop loss down here. You can go to a shorter time frame to determine a nice level of support, and I think it will be below that one right over there. But right, so that is what happens. Now you will also find that the MACD will do this, and then it will do that, and that's normally what happens right over there. Right, let me just move this a little bit so that I can have it more or less underneath it. So what I'm trying to say is, right over there, price is going up, MACD is coming down. There's divergence. So that immediately tells you that this uprun might run out of steam. And then you know, right, if I get involved here, or I'm still involved somewhere around there, I have to get out. So you get out of the market. If it is just a false alarm and it turns around there, then you can still get involved on the normal way. But you still know, unless it makes nice higher high again, you still know, and the MACD is following it, then you know you can still go on with the trend. Otherwise, you know there's a change that has come. Now, what is amazing is, what I want to show you is the fact that the moment it runs out of steam, the price normally goes. Let me just fix that up. Because of the 21 EMA being very sensitive to movement, you're going to get that type, or maybe not 100% that sharp, but you're going to get that type of thing. What happens is the price, when it comes below the 21, that's a 21 EMA moving average. Down here below, I just cut it off, there is the 89. 89 is going to go through somewhere around there. So what's going to happen is, when the price gets below the 21, it tends to pull back sometimes to the 21, sometimes just a little bit above, and then start coming down. So what do we see here? That normally comes a little bit higher up. I just want to... What happens is, there's a lower high. There's a lower high that tells me there's a possibility of a change in direction. Maybe just for the short term. It's not to say this trend is going to totally reverse. But that type of setup, I'm using it quite a lot. And the people that are with me in this uses that very, very often. Price closing below the 21, pull back, and then it starts coming down, and then it's going to go down. Well, not going. You've got a high probability that it's going to come down to the 89. Entry is just below that low there, unless there's a nice bearish candle or an evening star there in the top. So now you've got to look at price action, which are the actions of people. And an evening star is just the actions of people. There's no magic about an evening star. It's just that people make that type of decisions at a certain point on the information they have. And that's why the price is doing that. But if you are conservative, you can enter here, then you can have your stop loss up there. We do this quite a lot. Now, exactly the reverse is also working when the price is on the downside. Let me just quickly do that for you. Right, there it is, the upside down. Price coming is in a downtrend, and exactly the same happens here. So the moment you start seeing that, you know what your plan of action is. While it's doing that, coming down, you also know what your plan of action is. You want to enter as close to the 21 as possible. In the beginning, just be careful. Normally with a changeover, there's a lot of volatility. You're going to get some volatility over here as well. You might find here small candles, and all of a sudden, somewhere around here, the candles get bigger. And then you know, right, I have to look carefully because this might, then there's a momentum change. And when you see that, you know what to do. Right, let's start testing what I've just said. Let's just take that up run over there. You can see there, price going above the 89. There's the pullback. There's a pullback to the 21. There's a pullback. What happens here? Can you see there? Price going up. MACD coming down. Already tells you right over there. Be careful. And what happens is the price comes below the 21, pull back to the 21, and come down right to the 89. The 200 and the 365 EMA were all together there, so that was the target. Look what happened here. A lot of volatility, but the price pulling back, starting coming down. There's the TC pattern. You can learn about those patterns in Forex Factory. Right over there is the entry. Look at that tail going back. What does that tell me? Exactly the same that we saw there. Price coming down, and right over here was a huge turnover. You can see it there yesterday. And I think it was late yesterday, also, more or less. Sorry for that. And then the price is just running through. So I'm anticipating some sort of a pullback towards the 21 and then a move up towards the 89. So that will be again the rule that I will be looking at. In this case, there was no turning away from the 21 with a bearish candle. If that happened right over there, that would have been an entry. The 8 EMA, the role that is playing is just to keep me that the moment the gap between the 8 and the 21 is getting big, there is the chances for a retracement. The probability for a retracement back to it is always there. Right, here's the down move. Pullback, coming down. So there was a possibility over there. There's a nice TC right over there. But look at that little tail back upwards. That tail one have to be very, very careful if the 89 or the 200 are close by. They tend to test it. You're going to see that a lot of times. So if you did not take that trade, even if you took that, your stop loss had to be above the 200. Not just above the 21 because the 200 is close by. It had to be above. But if you missed that tail was the indication for a down move. And right over there we're talking about 80 pips. Right over here, price also coming below the 89. There's not really MACD divergence here. A little bit of a double bottom here between there and there, which is always, if they are that far apart, you must not look for it and see, right, what is it. Let it show its colors. You can see it was very far away from the 21. The 8 and the 21 is very far apart. Same there, same there. So one have to look for that. And what happens here? Price goes above the 21, pull back and start going up all the way to the 89. That's part of the ruling. Right. Another thing is when the 89 and the 200 and the moving averages is getting together, you get a lot of volatility, zigzag over them. And then one really have to be very cautious in how you trade that. And that's what I said. If you get something like that, is then you must establish yourself some support and resistance lines. There is 1, 2, 3, 4. So that was a definite trade. Because you have to establish the channel first. And the channel is only established after 3 points. The fourth one, a possibility if you want to take the odds on. But then you have to make it parallel to the top one, which to me is always dangerous because it never got there. I'll wait for the another point as well. And that pullback right over there, look at that nice, well, it's not 100% a morning star, but that's sort of a morning star. Get involved there, and the upper channel, that's 171 pips. And then that breakthrough coming down right over there, there was the entry again. So the moment you get moving averages getting together, you must know that you've got to establish the support and resistance levels, and then you trade in between for that. What you can do also is, let me just show you the power of this rhythm. So now you know that the rhythm is, let me just finish the rhythm first. I'm going to share that with you. Price going above the 89, there's the 89. So we are in bullish mode. Look at that. That is a pullback. There's a pullback. There's a pullback. There's a pullback. Doesn't need to come all the way down to the 21. That's a little bit maybe too far away. That's about 40 pips. But that's about, let's say, about 20 pips. That's after those two green candles there, you can enter there. But look at that. Price going up, MACD coming down, already telling you something. There's the price coming below the 21, pull back to it and even a little bit above it, and then it makes that lower high. There's also head and shoulders, and there it comes down to the 89. Right over here, price coming down, touches the 21, there's a deal, closes above the 21, pull back, goes to the 89. There was a total drop. That did not do that. So you're going to get that as well. So don't let that worry you, because that has kept you out of a trade. Because right over there, you would have closed it in any case. We were talking about this specific trade because I was on leave at that stage. Right, that consolidation, right over there, and that tail has given it away. So now we were waiting. And we went to a shorter time frame. You will see there is a triangle on the inside as well. Let me just see what time that was the 2nd of May, if I remember correctly, 3rd of May. You can see right over there, that was that tail going on the outside. What have we done? We've drawn that. And what happened? The price broke through it, pulled back to it, and started coming down. Entry was right over there. Now, I want to share with you now that you know the rhythm a little bit. Just look at the 1 hour. Those pullbacks. Right? You must be careful. The 1 hour, you're going to get that as well now. So the volatility on your flat areas, your range-bound areas, there's more of them that you need to get in. No. But look at those pullbacks. Those pullbacks. There's a typical example. There's 1, 2, 3, 4 places that you can get involved. There the price goes up that last stretch. MACD coming down. Price goes below the 21. Pull back. And now it takes time, but it's busy coming down. Okay, let me just... sorry, I haven't got the 89. I think I've set it, put it off on the 1 hour. Let me just put it on all time frames, because we're going to use that as well. You can see the price coming below the 21, pull back, come down to the 89. Let's go to, that's the 4 hour. Let's go to the 1 hour and get a nice one. Look at that. Price closing below the 21, pull back, coming down to the 89. That is, you can see there, chances to get involved in the market after 21. Right over there, right over there, right over there, right over there. Right, I know that after that you wait for a pullback coming down, but that candle showed me it's not going to happen. You can see there, it little breakout there. There's the pullback, just that little candle right over there, pull back to the 21, and then a move back upwards. That is entry time. Look what happens. it come and test the 89, then it went all the way back up. Right over there, there was my entry candle. That's the nice bullish candle of the 21. Small candles. When you get small candles like that on the 21, finding support, you know there's something coming. Finding resistance against it. There's another example. Price going up, closing below the 21, pull back, and then started coming down all the way to the 89. That's the market rhythm. Look here. Close above the 21, pull back to below it, and then eventually end up. This was a bit slow, but it ended up at the 89. Let's go to the 5 minute, just to show you, you can trade this on any time frame. It's amazing to see it. But as you can see now with the 5 minutes, now it's getting tricky. It's getting tricky. So you have to wait for a market that is on the motor, as I say. You see what you're getting now with the 5 minute. You've got to be very careful now. But let's look at it. There's a pullback, move away. So that's what you're looking for. Right over there, there's 20 pips. Right over there. That's on the 8 EMA, so careful there. Don't trade off the 8 EMA. You trade off the 21. There's one. Going back up, 18 pips, but there's already MACD divergence. Somewhere around there you should get out of the trade. Let's even go to the 1 minute. There's a 1 minute. Look what happens, how many times of the 21. What happens at the end? Close below the 21, pull back, come down to the 89. Right, this is obvious, some news time, so that is. But let's just take today's move. I'm still updating. That's why. Let's give it a chance to update. Right, there's today's move. Let's just quickly just look for this morning. You can see it's 13th of July. Below the 89, there's the pullback. There it comes down. You can see right over there. Because of that pullback coming down, entry is right over there. That's about 21 pips. Price coming down, MACD, a little bit of divergence right over there. Price closing above the 21, pullback, and then eventually it went to the 89. And then right over there was an entry again because it pulled back to the 21. That would have been most probably a wrong deal. But just remember, on the 1 minute you're going to get that. But now it's in rhythm again. It's below the 89, pull back. And here it closes above the 21, pull back, going to the 89. Right over there is a deal. Right over there is one. Then you get this move down here. And then eventually it starts moving up. There's one, there's one, there's one. That one, sorry, it was also one. Here's the price now moving below the 21. So what are we looking for now? We're looking for a close somewhere around there, pull back to the 21, and then coming down towards the 89. So we're talking of about 10, 11 pips should the 89 meet it right over there. That is the market rhythm on any time frame. Let's take the daily and see what the daily does. 21s, 21s, 21s. There's the the close below, pull back towards the 21. Did not get there 100%, but eventually got down to the 89. Look what happens here when the moving average is starting to get together. A lot of volatility. But I can show you now how many times you could get involved in trades. Right over here. Look at that beautiful 1, 2, 3. And when it came back right over there, could get involved right over there for 300 pips, going back up. Taking the odds on, because the moving averages are there. The price is zigzagging all over it, so it's ignoring it. So it's obviously that it's got some other support and resistance places. In this case, it was this bottom one. And when it got up there, there's another 280 pips down. Right, that one was a wrong one, but you only had about 70, 80 pips stop there. And then when it finally broke out, now you're waiting for the rhythm. You can see there's the 21 coming. So now if it meets somewhere around there with the 21, you can get involved in the market. There's a nice up run. This one was a huge up run, far from the 21, so that was very difficult. You could not get involved right over there. That was just too huge in any case for me. And but what you could see here is price going up, MACD coming down, divergence. Price coming to below the 21, almost to the 89, pullback, and that bearish candle there, down to the 89 is 170 pips, according to the rules. Another thing that happens is when the price gets in between the 89 and the 200, you also get a lot of volatility. So then you trade off the edges. In this case, it ran through, but at least there was one and there was one that you could have traded. There was one. You can even take that one upwards, 365, that one down, 360, this one at least 280. So, but you won't let that come into a loss. I mean, that should, if you entered there, that trade should never come to a loss. Right, what role does the 365 play? It normally plays a role when there's the moving averages, the price ran away for the moving averages. I'm just looking for one. Now that doesn't happen a lot. I'm not using it quite a lot, but you will find it, let me see, on the 4 hours. Let me look on the 4 hours. There it's much more than on the daily. We had one. I'm just quickly going to search it for you. Right, there I found one. You see the price has totally run away from the moving averages, so it gets it right over there. I'm not using it that often. There's people that are using it, especially when the price is in between the 89 and the 200 as well. You'll find that somehow it gets support or resistance on the 365. I normally uses a Fibonacci extension, the 161% Fibonacci extension, to determine if it starts running away. You can see it right over there. There's the move down. You can see 161.8%. That's what I normally. When I see that type of stuff right over there, I know this is running out of steam. There's again closing above the 21 and eventually get to the 89. That rule, I use it, the same principles that I'm telling you here, I'm using in stocks. I'm trading stocks exactly the same way. Right. Let me just quickly share with you some of the. Okay, yeah, I want to go to the weekly as well, just to show you that even on the weekly graph, you can use exactly the same concept. Look there, from the 21, 21, 21, 21. Right over there, it screams, it tells you this is running out of steam. Right there you could see already there's something boiling. But eventually it made that last one, and then it started doing that. From the 21, 21, 21. From the 21, that would have been a false one or a wrong one. From the 21. And you stay in it until you see definitely some consolidation far away from the 21, above the 8 EMA, like over there, and you know, like there, you know you got to get out. Right over there, right over there. Let's go to the monthly. You can see how many times it comes from the 21, right over there, into right over there. I mean, that's nearly 3,000 pips up till there. You can see lately the volatility we had. So there's definitely something going to happen. You can immediately see that as a support line. There's a support line there that got broken. twice pull back to it, so I won't be surprised if we see some move going upwards to test that high of 158. But that's just my assumption, or my anticipation is the word that I like. Right, so 5 minute, you can see right there coming down. There's so many ways that this can be traded. Look at that move towards the 21 and move away. This was quite a strong move today. Currently, let's look at the 1 minute. Let's look what the 1 minute did there. Then we can see, you see, they not really went back to the 21, so that was not, but you can see almost before it, maybe it's going to go back there and then down to the 21, but one needs to have it a little bit closer right over there. But that is the rhythm. That's the market rhythm that I trade. Let me show you the different setups quickly. There's one that we trade. We talked about the TC. There's another TC right over there. Right. A lot of people are just trading off the MACD. Now, the MACD, the reason why I implemented the MACD and those signals was like that one over there, is just to give the guy the edge in his favor, that he doesn't enter way down or way up, and then you have to sit out a pullback, and then his account cannot handle that. That is the only reason. But if you start knowing, for me, for instance, I'm not even looking at the MACD to do my entry. I look at the MACD on the top to see, is there any exhaustion of this move? Is there any running out of steam of that move? That's what I look at. That's almost what we call a zero bounce. There it is. When it bounces off zero, it's normally on the 21. That is a beautiful setup. But you see where it brings you in right over there. I would have entered after that second tail, little tail to the bottom. That's where I would have got involved in the market for 66 pips. And at least right up there, 80, we're talking about 120 pips, somewhere around there. If you were strong, you could lift it, and it all depends on your emotions and things like that. Head and shoulders is always something we look at. That's a very strong signal as well. We take it there. Right, look where the entry was. Right on that small one, coming down to the 21 for 70 pips. Head and shoulders is what we're looking at. And then a zero, there's also a zero bounce, but that's off a huge candle. Now sometimes those signals comes late, but look at that spinner there at the right place. Little tail to the top. I mean, I don't even think twice to enter there. Look at that nice momentum change. Look at that TC right there, coming down for 154 pips. People tend to trade every MACD signal, and that's not what you must do. You must wait and look for the right signals, the right setup. There's a zero bounce again after 21. Beautiful setup, 106 pips. Look at that TC now, trend continuation pattern, but that's a huge candle. Are you going to get involved there? What you can do is, with the moment the price gets to the 4-hour 21, you can switch to a 15-minute and look for an entry maybe earlier on. Look at that resistance line there that got broken. That's part of the rhythm. There's that nice pullback and then a move away. So you could enter somewhere around there if you use that and use a breakout strategy. It's not just a breakout, you just traded a breakout. You traded it according to market rhythm. That to me is very important. I'm trying to look for, there's a zero break. Sorry. MACD going to below the zero, pull back to above it, right over there. Unfortunately for that, you have to wait for the candle to close, because you never know whether that's going to come down. So that is unfortunately. Sometimes you get a huge candle. In this case, it worked out positively. Look at that TC right over there. That tells me they don't know which way. That tells me they know which way. That's based upon information. That is the information this site, that tells me that's the information. It's up and down. This one tells me they know now which way. That tells me they don't know which way anymore. This one tells me they know which way. Eventually, it first came down, but that tells me there's something coming. There's something coming. And look at that move upwards. Look at the volatility of the market there. Right, I'm quickly going to share with you just something else quickly. That's about stop losses. What I've done here is I've just added the average true range indicator, and I put the settings to 1. That tells me each candle, that specific candle, was 138 pips. You can see it there on the right hand side, right over there. It was 138 pips. That specific one right over there, the high-low, was nearly 200 pips. Now, all that telling me is for the current price action right over there, I can see what the volatility is more or less. Now, when I started in the beginning, now this doesn't go that far back, but if you go down to 2007, 2006, you will find that some of these I've traded off of 50 pip stop loss. You will see in the thread I say I don't trade with a stop loss greater than 50, but it has changed so dramatically the last couple of years that, I mean, there you're talking about 145 pip average. Or not average, the tops, but average, I would say we're talking about 100 pips. That is 100 pips. Candles. Just this last candle right over there, we're already talking about 150 pip. One candle. So now you can, if you want to trade with a stop loss of 30, you're definitely going to get trouble. So that's the way that I look. And another thing is when I see volatility pick up at the end of a move, or sometimes right over here, you can see here, there when everybody was in agreement, it's coming down, but then right over there, you can just look at that volatility right over there before it gets direction again. That's the type of stuff you have to look at as well. I just quickly added there, but if you know what to look for, I mean, you can see it. You can see the volatility there. Where's that nice move that there it is. Look right over there. Small little candles, one here and there that is big, and then all of a sudden you can see that there's something happening over there. And that's what you got to look for. That's the market rhythm that I'm talking about. That's a rhythm when the moment you see a lot of people gather together, you should know there's something coming up. But nothing prevents you from trading that. If you know what you're doing, you can get involved there. There's nothing that prevents you from getting involved there. Look there. Because it has been established already, right over there. This channel has been established, right? One can refine it a little bit, something like that. But and even on the right hand side, maybe a little bit lower. But look how many times you could get involved there, right there. That should not go to a loss. I mean, you're talking about 56 pips there on a 15-minute graph. We changed to the 15-minute right over here to get that move down. And that was right over there. You can see there. And when it dropped through, if you go closer, you will see there what happened. We call that railway pattern. That railway pattern of the 89 and the 21 of the 15-minute time frame. That one there, that is what put us into alert. And the moment it dropped down below that spinner there, that's where we entered for a lot of pips. Well, that's basically the market rhythm. Let me just think. Okay, I'm going to give you that link. Just one moment. Right over there. There's the link that you can use to get to the thread. That that I've started, I think in 2000 and, was it 7 or 5? I can't remember, it's so long time ago. But it's been visited over 4 million visits so far, and I think there's something like 25,000 posts. There's a lot of stuff to work through, but on page 1, there is a summary of all the links, and that is actually your library. If you work through that first page thoroughly, I think you will have a good idea of what market rhythm is about and how to enter it. Just remember to adjust for the stop loss. It's not going to work on 30 pips anymore, things like that, so you have to take that amount into account. Just work out your position size correctly in terms of your risk-reward ratio and your capital available. Right, just to show you today's graph, you can see there, 13th of July. I wanted to delete that, but in any case, just look at that, where it comes from. Look where the price have halted. It's not to say it's going to go inside, it can still go because this is still an active candle. The next one can do that, but why did it just stop there? Why did it halt it there? That's what I call market rhythm. It's amazing that people are using that limits. And that's another thing, is when people likes to have boundaries and to operate between boundaries, because then they know that's their comfort zone, that's their security zone. And to me that is very important when you start seeing that, especially around the moving averages. Look at the moving averages coming together right over there. That's why I'm doing a weekly anticipation as well, a video every Sunday, that people can, what I say that what I anticipate for the week. And we talked about on the daily graph about that specific volatility and that there's something coming. And then eventually it did broke out this week, going over 300 pips, and it returned 300 pips. Amazing. Amazing to see that. But there you can see it. You can see the volatility on the daily. Nice rhythm, all of a sudden not in rhythm. But opportunities, there's a lot of opportunities in there. If you switch to a smaller time frame, but you know where you are in terms of the whole picture. That's very important. If you know where you are in terms of the whole picture, then you know what to do, how to trade this in between, because you got the whole market rhythm in your picture, in your mind or in front of you, and you know what's happening right inside there. That's why I say very important to have that. Look how the 365 and the 200 has played a role also there. It's not on the pip exactly, just remember that. But that is the indication. So if you go to the 4 hours now, let me just quickly mark that area there. You go to the 4 hours and let's see what happened on the 4 hours. Railway track. What does that tell you? Price closes above the 8 EMA, pullback started moving back upwards. To me, there was an entry based upon that what we had there. That is the daily 200 SMA with a railway track and a bullish engulfing candle there. What do you want more? That's market rhythm. Right, that's it. I hope this has really helped you. And I hope that you can use this to make your planning better. To me, that is what it's all about. It's not about trading a certain system. It's about knowing the market and knowing the movement and why it's moving like that. Sometimes you're not going to know why. Why, I mean in terms of people's decisions, because you're never going to know why. By the time you find out why the market is moving, it's too late. I always have this explanation. I say to people, when I'm sitting in a place and all of a sudden a couple of people come running through here with speed, and they don't normally do that, I ask myself, why are they running? So I can either go and investigate why they are running, and I might face a lion or a leopard or an elephant or something like that. or I can run with them. And while I'm running, asking, why are we running? You get what I'm saying? It's about to be in the rhythm with the people that are doing the moving of the market. The moment you're in with them, they have to shoot themselves to shoot you. But if you want to get in at times when they're not running, then you're in trouble. That's what it is all about for me in the market rhythm. Right, that's it. And I hope you make